Demand for European and American currencies has remained almost unchanged this week. The news background during the first 4 days of the week was rather weak. To be more precise, it was practically non-existent in the first 3 days, with the market only encountering secondary information from Germany. Significant news emerged today, but it neither influenced nor could influence the current wave marking. Reports on GDP for the first quarter and durable goods orders in the U.S. fell short of market expectations, causing the dollar to decline. However, a day earlier, demand for the U.S. currency was rising despite the absence of a news background. The market is holding its breath, waiting and accumulating volumes. Today, one of the ECB's policymakers, Olli Rehn, stated that 2 rounds of monetary policy easing by the end of the year seemed to be the most reasonable scenario for the regulator. He emphasized that the regulator must bring inflation back to 2, but at the same time, the ECB should not overly weaken economic activity. It's worth noting that Rehn is not the first ECB politician to consider 2 rounds of a 25 basis point rate cut as the most rational decision. Meanwhile, another ECB policymaker, Peter Casimir, mentioned today that the markets should expect 1 rate cut by the end of the year. Mr. Casimir has become effectively the first ECB official to speak of only 1 round of easing. Thus, his opinion remains in the minority, and we should expect 2 rounds of easing. I remind you that the primary reason for the decline in the European currency is the ECB's shift to a more dovish policy. The more significantly, the ECB's rate decreases while the Fed maintains its rate at peak levels, the more the euro will depreciate. The longer the Fed keeps its rate unchanged, the more the euro may fall. Consequently, the market still has ample time to form a new downward wave and complete the construction of the entire downward trend segment. This is the scenario I am counting on.